Good morning. It's Tuesday, December 13th. This is Mike Mock with the Lansing Trade Group Morning Comments. Before we get rolling, I want to make sure everyone's aware I'm on business travel the balance of the week. I'll be traveling across Indiana, Kentucky, and Tennessee, anxious to see what soft red wheat looks like down there and any indications of the sharp cutbacks that we've been hearing. Also want to talk about, we'll try to post on the weekend, maybe an update of how the week's travels went, and then I'll be back on the normal schedule Monday the 19th, right through the balance of the calendar year. Yesterday we talked about the breakout in the oil trade, the fact that crude oil had run to a dramatic high here, the highest we've been in over a year and a half. We want to make sure that folks are watching as we approach Friday. You want to see a weekly close if you're a crude bull above $52. Obviously a nice run yesterday, but we did ease back a bit, and there's already talk or concern that will people cheat on the agreement, or will folks not involved in the agreement like the U.S. Really ramp up production. So we think Friday's close is important, and we mention that also in terms of our ag producers, because it's hard to get really excited about an inflationary environment and about commodities running with the dollar so strong if crude oil doesn't kind of lead the way. So we want to watch that very closely. The other thing we talked about yesterday was the fact that we're rolling out a bean campaign. We did see some standard new crop bean hedging. We think that's great. November beans spent most of the day yesterday at roughly between $10.20 and $10.25. We did roll out a min-max averaging contract that had a really good response, particularly from our folks up in New York. They're to be congratulated for getting involved here. We did make an adjustment in the strikes from what we discussed yesterday. We used a 1020 floor. We went for the higher floor with the 1080 ceiling. So we got a 60-cent window at a 20-cent cost, but we, anybody that participated knows that they will have no lower than a $10 November futures net floor, even with the cost of the premium involved. So we think that's a really good way to approach it. And as we go on through the week, if we close today at 1022, that's what today's increment will price at. If we rally to 1028, it'll price again. But we do know that if it slips below $10.20, for example, if on Friday it closes at 1018, your increment will price at 1020. We think that's great. Now, we're still in the camp, again, we're not capable of really, predicting prices to the degree that we knew that yesterday was the day to sell it. If so, we wouldn't use these kind of tools. They're designed to protect us when we like the profitability, but we're unsure of where price weakness or strength may lie. So we want the market to still go higher, and we would encourage folks to be prepared for the next step. If we would get November beans to rally up towards 1050, 1060, 1070 certainly, then we would be preparing for the next floor ceiling. Something, if we can rally to a 1070, 1080 area up near the high that we just established on the first one, that we would look at something like a 1050 floor with an 1130 ceiling, something of that nature. So be prepared for that. The other thing I want to mention is that in the case of beans, this was an opportunity for the grower because we know we're clearly profitable here, and the risk is we see a big shift in acres. So as opposed to an opportunity, I think that the potential next rollout of the min-max will focus more on the risk. And the biggest risk we see out there with the majority of growers that we talk to is in old crop corn. They're dramatically underpriced. We're rapidly approaching the first of the year. Cash flow needs, quality concerns are probably going to force some movement. So don't be surprised if we roll out some form of old crop min-max in the days ahead to a similar kind of campaign. Just as an example, and we haven't decided on this by any means, we'd actually encourage you to share your thoughts with us, but a 370 July floor with a 410 ceiling would be pretty darn reasonable today. Those are the kind of things we're going to look at. And with December corn futures a couple pennies higher than where they averaged last February, don't be surprised if we look at something like a 380 420 or a 380 430 in the new crop as well as a place to get started. And we really think that's important in corn because these are prices that are not clearly profitable. We're trying to establish floors with some upside potential just to be safe. And again, we're talking about higher risk bushels. In the case of old crop, folks that still have 3/4 or more of their old crop corn need to whittle that exposure down. In the case of new crop, for example, if you have a certain percentage of crop you can't store, we would want to focus on that. So again, don't be surprised next couple of weeks as we approach year end, we have another campaign, this time focused on corn. Y'all have a great week. I'll talk to you first of next week. Again, see you then.